Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. 2022 has been one of the toughest market environments in decades. And I'm not just referring to the stock market here, I'm referring to pretty much all assets, right? You take a look at gold, you take a look at treasury bonds, which are meant to be a hedge. Pretty much all assets have been going down and are in negative territory throughout 2022. You take a look at emerging markets, they're down. You even take a look at consumer staples, what's known to be a defensive sector of the SP500. Even XLP is down throughout 2022. Of course, all of this has been driven by the Fed that's been raising rates, right? You take a look at the federal funds rate, you can see that very clearly. It's been rising. They've been announcing rate hike after rate hike in one of the most aggressive fashions we've seen in decades. I actually do think this might be the most aggressive tightening cycles in history. But there's a lot of people out there that are currently saying that the Fed needs to raise rates above the inflation rate. Some people say the Fed needs to raise the Fed funds rate above the core PCE inflation. Others say that they need to raise it above the rate of headline inflation, right, which is currently sitting at 8.3%. So the federal funds rate would need to at least be at 8% in order to actually get inflation down. And the big argument behind that is the 1970s. As inflation rose, the Fed systematically had to bring rates above the inflation rate in order to end that inflation spiral, right? And so that's what a lot of people are very concerned about, that this is only the beginning of the hiking cycle of the federal funds rate that's been driving all assets down. And if you take a look at our Twitter at Game of Trades _, you can see the AAII bearish sentiment that we posted a few days ago, showing a historical amount of bearish sentiment not seen since 2008 and before that 1990. So we're going to talk about that in this video because that is pretty concerning. If we are indeed in an environment where the Fed needs to raise rates to 8% in order to get inflation down, well, then we can say for sure that this is only the very beginning of a much, much larger drop in the market, and that this is actually what's in store for us, the 1974 hiking cycle, where they had to raise rates a lot higher and actually trigger this type of massive move down in market valuations. I think this is a very important topic where a lot of people are very confused. We're going to present our take on this and how we're thinking about this dynamic right now. By the way, if you are new here, don't forget to smash that subscribe button. And if you enjoyed this episode, if you appreciate the time and effort that goes into putting these videos together for you guys, don't forget to hit that like button as hard as you possibly can. Now, without further ado, let's get right into it. So I want to start off by showing you guys a chart of the 3-month rate going back to 1934. Now, the reason I'm showing a chart of the 3-month treasury bill is twofold. First of all, because it pretty much tracks the federal funds rate exactly. And secondly, because there's actually no data of the federal funds rate that goes back further than 1954. And that includes the Fed website. So if you want to find out what the Federal Reserve was doing with monetary policy before 1954, you have to take a look at the 3-month treasury bill. And so that lets us actually take a look at a big part of history and see what the dynamic back here was between the interest rate and inflation. You can see how closely the 3-month treasury bill follows the Fed funds rate. It's pretty much the same chart. So let's add the inflation rate on top of this chart. And first of all, let's focus on the 70s. Clearly, you can see every time you saw inflation, so that orange line got heated, right? For example, here it got to 6%. You had to see the federal fund rate, and you can see on the right axis, go above the rate of inflation, right? So here, throughout this period, that theory definitely proved to be true. Inflation did not stop until the Fed funds was above the inflation rate. But let's zoom out here and actually take a look at the 1940s. And here you're going to see that this entire theory gets completely broken apart by just looking at this data set. The federal funds rate was at 0.2% for almost a decade here, and it actually never went above 2%. Here in 1953, that was the peak, a 2% interest rate. And you can see throughout this entire period here where the federal funds rate was very low, we had inflation go up and down very violently. So yes, you saw major bouts of inflation where you actually saw a 12% inflation rate and even a 19% inflation rate in 1947. But the point is that the Fed didn't need to hike the interest rate above the inflation rate in order to get it down. And you can see, for example, between 1942 and 1944, we saw 2 years where inflation went from 13% to 0%, right? 0% inflation without the federal funds rate doing anything. So for me, this is the proof. Just zoom out a little bit into history that it's a complete myth that the Fed funds rate needs to be above the inflation rate in order to get inflation down. Then why did this happen? Why is it that in the 1970s, the Fed actually did have to raise rates above the inflation rate in order to get it down? What happened here that wasn't the case right here? That's a big question if we want to understand what's going to be happening right now. Now, to me, it comes down to inflation expectations rather than the inflation rate itself. And you can see here between 1964 and 1980, right? So 15 years where we saw inflation not only trend up, right? It was trending up, but it never actually went to zero. You never saw a moment where prices were stable, right? So this was a 15-year period where consumers got used to rising prices over a very extended period of time. In the 1940s, that wasn't the case, right? Yes, you did have very significant periods of inflation, right, where inflation reached absolutely staggering numbers, but it came down, right? It came down and it went back to zero. And in 1949, it even went below zero in deflation. This was much more a period of extreme volatility in prices rather than the 1970s where you had a 15-year period of rising prices. So that really makes a difference in consumer psychology where here people are getting used to prices rising and so they're spending accordingly to their expectations of inflation, right? If you think that prices are going to rise next year by 10% because that's what happened last year, you're going to go out and spend more as soon as you can. And you're not going to save any money because you know that inflation is going to erode your purchasing power. So when you have that consumer psychology that really takes hold, which was the case in the 70s, it's kind of a self-reinforcing cycle of inflation. So what are inflation expectations today? Right, obviously, we haven't seen a 15-year period of inflation. We've seen a 1-year period with high inflation rates. And this is a chart that I think represents inflation expectations quite well and compares today. So this is the 1-year break-even rate and the 5-year consumer-based inflation expectations, and you can see the market expectation, so that black line, market expectation is below 2%, right? So it's very, very low in terms of what the market is actually pricing in right now for inflation in the next year. Think about that. Now, the market can be wrong sometimes, and that's something to be aware of, but very often the market is right. And this is what it's pricing in right now. And this is the 5-year consumer-based inflation expectations. That's in blue, and you can see it's just above 2%, right? And it's remained quite stable. It went up to 3% in the first half of 2022, but now it's been trending lower. And you can see where the consumer-based expectations were in 1979. They were above 7%. Obviously, the Fed had to raise rates above 7%, right? That makes sense. If people expect inflation to be 7% and they see an interest rate below 7% at the bank, why on earth would they save any money if they're expecting inflation to be above 7%, right? That doesn't make sense. You don't save money when you think inflation is going to be very hot. In fact, if you're smart and you're convinced that inflation is going to be higher than 7%, you have to borrow money. If you have an interest rate that's in negative territory and you think inflation is going to be hot, then go out, borrow that money, spend it on productive things. And in any case, inflation is going to make it that the money you borrowed is going to be cheaper a year from now to pay back than it currently is, right? That's how inflation works. And when inflation expectations are very high, it's a big, big risk because you start to get into that dynamic where people borrow more, they spend more, and they save less because they're expecting inflation. This is not the dynamic we have today. If we fast forward 10 years from now, that could very well be the case. If we see irresponsible fiscal policy, irresponsible monetary policy, and we see inflation trend up, right, you could definitely be in a scenario where you end up actually having inflation expectations around the levels we had in the 70s. But people who claim that this is the environment we're in today, I think they're missing a big, big part of the picture regarding inflation and monetary policy. Now, of course, that's just our opinion. Let us know what you think in the comment section down below. So we don't think there's much more room for the Fed funds rate to actually rise from here. Now, perhaps they're going to hike one more time in November, one more time in December, but we think the vast majority of the tightening cycle is behind us. This is a chart that shows this. It's basically financial conditions minus the neutral rate. And so it tells you how tight monetary policy is. And we are in a very tight monetary policy right now. Tightest that we've seen since 2006, 1999, and 1989. So we know there's going to be a recession in the 1 to 2 years that follow. Here it was 2 years before the recession happened. Here it was 1 year, and here it was 2 years. So you're going to see the Fed have an increasing amount of pressure to stop tightening. And what history shows is that if earnings hold up, which we think is going to be the case at least in the next 6 to 12 months, the market can get very excited about the Fed at least getting a little bit less aggressive. So as that happens, as the market gets excited about that type of development and it begins to get priced in, which is definitely not the case right now. None of that is priced in right now. And in fact, quite the contrary, the market is very worried about the Fed. But when the market is on its road to recovery, we're going to start to pay attention more and more to the tail risk of earnings declining, right? Because just like in 2007 and in 1988, right here, this tightening cycle is going to have an impact on the economy. It's going to lead eventually 1 to 2 years from now to declining earnings and potentially a much larger bear market than the one we had throughout 2022. So that's going to be an increasing part of our focus at gameoftrades.net. We're going to be watching that very carefully in the months ahead and incorporating that into our model portfolio that we just released last week, really representing our entire thesis right now, how we're positioning, and also how we're hedging against the tail risks in the economy right now, which again is going to be a bigger part of the focus in the months ahead. Now, our website is going to be completely revamped in the second half of October, where we're actually going to have an entire dashboard for the members that organizes our trading watch list, our model portfolio, our targets, our buy and sell ratings. And so all of that is going to be clearly visible on the front page of the website. So make sure to grab yourself a free trial right now, test out the service, see if this is a service that you'd be interested in. One of our priorities at Game of Trades is to make sure that once you do get the membership at a certain price, you're going to keep that subscription price regardless of price increases in the future. All right, now let's quickly take a look at the short-term technicals on the S&P. We had a brief bounce over the last couple of days. Now, internally, I know this is a very strong rally. This is the best 2-day performance we've had since COVID. We're going to talk about that in an SP500 update that's going to be posted on gameoftrades.net tomorrow. But in the meantime, I do want to show you a few developments. First of all, we have a bullish crossover on the MACD. So bullish momentum on the daily chart seems to be returning. The last time that happened was right here. Now notice what happened when we got that bullish crossover back in June. It was right here. So you did see a pullback after that initial thrust. Back in May, right here, you can see the bullish crossover happened. Right here, you got a brief rally. Then the market took out their lows. Now internally, let's go to the 2-hour chart, and I want to show you guys something. Let's put a line chart on the S&P, put J&K, the high yield bond ETF on top, which throughout 2022 has been incredibly great at predicting tops and bottoms on the stock market. So this is just one additional piece of information to take into account when it comes to the market. You can see we highlighted that divergence that we had leading up to the bottom. You can see the S&P in blue here was coming down, but J&K was telling you, nope, we're going higher. That triggered that big run. That was a 6% move up on the S&P, and now we're kind of seeing the opposite occur, right? So this gives a bearish bias in the near term and could signal a little bit of a pullback in the very near term. That's not a surprise considering the strength that we saw right there. And you can see we saw the same thing back in June here on that little top that we just talked about. J&K was moving down here as the market was moving higher, predicting that short-term correction. And by the way, we saw the same thing in May right there, where the market was making a higher high and the S&P was moving lower. That kind of foresaw this move down. So I guess the corporate bond ETF is giving us a very short-term bearish bias, suggesting a counter trend move here, unless it's able to burn through that divergence. You see J&K make a higher high, then that changes the dynamic. Now, of course, it's nice to look at the short-term technicals. It's fun, but our real investment strategy is based on the 6 to 12 month investment horizon. But of course, we're looking at the near-term technicals to get a sense of how the market is behaving, what kind of signals we're getting in intermarket dynamics that can help us not be too optimistic at the market at the wrong moments, and also not be pessimistic at the wrong moments. I know there's a lot of people that were waiting for a larger move down on the market right here, right as we had a lot of signals that were telling us that we were going to see a bounce on the market. I think the rally that we saw throughout the beginning of the week was really a short squeeze. A lot of people were short here. They got squeezed in a big way. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.